Ever feel like you're just staring at a chart, maybe drowning in trading indicators, but still missing those perfect entry and exit points?
Happens all the time. Yeah.
What if there was a way to see, both the direction and the momentum of a trade really helping cut through some of that noise?
That's a key challenge,
Yeah.
absolutely. And in this deep dive, we're actually going to break down a specific approach that, well, aims to provide that kind of clarity.
Exactly. So today, we're zeroing in on a really practical source. It's a YouTube video called How to Trade, using CCI indicator for day trading, CCI indicator trading strategies for beginners. It's from the Trading with Grow channel.
Right.
And what I like is it's not just theory, it's getting into actual strategies.
Yeah, what makes this video useful, I think, is that focus on actionable techniques for day traders. It's not just defining the commodity channel index. It really digs into how you might apply it, intraday.
So our mission here is pretty straightforward.
Okay.
Let's really get under the hood of the CCI indicator. We're going to unpack two specific strategies from the video. First, trading with the trend, using moving averages and CCI together. And second, spotting potential reversals using something called CCI divergence.
Two core applications right there.
Yeah, the goal is really to pull out actionable insights, help sharpen your understanding of how these indicators can work together. Okay, let's get into it.
Let's start with that first one, the trending market strategy. Using CCI with moving averages to hopefully find better entry points when there's a clear trend.
Right, the basic idea is using the CCI almost like a confirmation signal once you think you see a trend, using those moving average crossovers. It's about finding confluence.
Precisely. So the video starts with the basics of CCR, Commodity Channel Index, and the presenter explains its strength is showing both direction and the strength, the momentum behind a move.
Which is really useful, they mention, especially for options buying where momentum matters a lot.
Definitely. And they stick with the default setting in the video, a 20-period CCI. And the key levels are plus 100, seen as overbought price might drop, and a negative 100, oversold, maybe hinting at a bounce.
But, and this is important, the video points out that just using CCI on its own, it can throw off a lot of signals.
Yeah, too many sometimes, especially if the market's choppy, not really trending strongly.
You get those whipsaws.
Ugh, whipsaws.
Hmm.
Yeah, those quick moves that trigger a trade, then immediately reverse. Small losses add up. CCI alone can be prone to that.
So that's where the moving averages come in. They act as a filter, basically. Help you ignore some of those noisy CCI signals and see the bigger picture trend.
And for this specific strategy, the video uses the 20-period and the 50-period exponential moving averages, EMAs.
Right, EMAs.
The classic signal is the crossover. When the shorter-term 20 EMA crosses above the longer-term 50 EMA, it suggests, potential upward momentum, a bullish trend starting.
But, as the video correctly notes, just jumping in right at that crossover moment,
It can be late.
yeah, you might miss a good chunk of the move already.
Exactly. So the video lays out a more refined three-step process for entry using CCI for that extra check.
Okay, what are the steps?
First, you need that bullish crossover. 20 EMA above the 50 EMA, that establishes the potential uptrend.
Got it. Condition one.
Second, you wait for the price to pull back to retrace a bit and actually touch one of those EMAs, either the 20 or the 50, like a little pause in the uptrend.
Okay, the pullback. Makes sense.
And then the third, and this is really the key trigger, the CCI confirmation. After that pullback touches the EMA, you only enter when the CCI crosses back above the negative 100 level.
Ah, okay. So it's not just the pullback, it's the CCI confirming momentum is picking back up after the pullback.
Precisely. It's trying to balance trend following with momentum timing. MAs show the trend but can lag. CCI, looking at the speed of price change, potentially times the entry better within that trend.
And they show an example, right?
Yeah, on a 5-minute Bank Nifty chart, they walk through it, see the crossover, wait for the price dip to an EMA, then bam, CCI crosses above negative 100, and that's the potential buy signal in their example.
Interesting. And they also mention adding to winners.
Right, pyramiding. If the uptrend keeps going and you see the same setup, again, another pullback to an EMA, then CCI again crosses above a negative 100. The video suggests it could be a spot to add to your position.
Makes sense if the trend is strong. And you use a trailing stop loss, presumably.
They mentioned that too, yeah. Using a trailing stop to lock in profits as the trade moves in your favor, but still give it room. Essential risk management.
So for you listening, the value here is aiming for more precise entries than just using MAs alone. Waiting for that CCI confirmation after a pullback is looking for that extra bit of evidence that momentum is returning. Potentially fewer premature entries.
Avoids chasing, perhaps.
Okay, let's pivot now. The second strategy. Using CCI to spot potential reversals. How does that work?
This uses a concept called divergence. It's quite different from the trend following approach.
Divergence. That's when the price and the indicator don't agree, right?
Exactly. They start telling different stories. And that disconnect can be an early warning that the current trend might be running out of steam.
So how does it work with CCI specifically? The video gives an example.
It does. They show it's called bullish divergence. So imagine the price is still making lower lows. Looks like the downtrend is continuing.
Okay, bearish price action.
But at the same time, you look at the CCI indicator and it starts making higher lows.
So price down, CCI up in terms of its lows.
Right. That disagreement, that divergence suggests the selling pressure might be easing up. The downward momentum is weakening even though the price hasn't turned yet. It hints a potential upward reversal could be coming.
And they show this on the Bank Nifty chart again.
Yep, same chart, different situation. They point to where price makes a lower low, but CCI makes a higher low. And they present that bullish divergence as a potential signal to think about a buy entry, anticipating a possible turn upwards.
Now, this leads into something quite interesting. They discuss comparing CCI to RSI, the Relative Strength Index.
Yeah, this was a notable part. The presenter makes a case that CCI might, in certain situations, be better than RSI for avoiding false signals, especially in sideways or maybe just weekly trending markets.
Why is that? What's the argument?
Well, the observation is that RSI tends to be a bit more jumpy, more volatile in its readings.
Okay.
So because it's more volatile, RSI might dip into oversold or pop into overbought territory more often, which means more potential signals.
But maybe not all good signals.
Potentially, yeah. Some could be premature, especially in those choppy conditions we mentioned. You might get faked out. The way they're calculated is different. CCI looks at price versus its average, scaled by deviation, while RSI is about average gains versus losses. That difference matters.
Yeah, and they mentioned RSI settings too. Like the default 14 period sometimes doesn't clearly hit the standard 70-30 levels unless you tweak it.
Right. They actually demo changing the RSI period down to 4 or 5 to make it show clearer oversold readings in their example, which kind of makes the point you might need to adjust RSI more often.
So the argument for CCI is that it's smoother.
That's the gist of the comparison in the video. They argue that during the same period where RSI might give multiple buy-sell signals because it's bouncing around, CCI might give a clearer picture of the ongoing trend. It tends to stay above plus 100 or below negative 100 for longer during a strong move.
So potentially less noise, fewer whipsaws if you're trying to ride a trend using those overbought, oversold levels.
That's the potential benefit highlighted in the video, yes. Fewer premature exits or entries in some market types.
Okay, let's pull this all together then. Key takeaways from this deep dive into the Trading with Grow video. 2 main CCI strategies.
First, using CCI with moving averages for trend following. The goal there is better entry timing after a pullback, using CCI to confirm momentum's return.
Right. And second, using CCI divergence, that disagreement between price and the indicator, to potentially spot trend reversals early.
2 distinct ways to use the tool.
And we also touched on that comparison. The video's view on CCI may be offering advantages over RSI in certain conditions, potentially fewer false signals when things are choppy or sideways.
Understanding these strategies, as laid out in the source, definitely gives you more tools for your analysis toolkit. Thinking about momentum, timing entries, spotting potential changes.
Absolutely. Hopefully this deep dive saves you some time and gives you a solid grasp of the techniques they presented.
Yeah, it's about understanding the why behind the strategy, not just the what.
So a final thought for you to consider. Now that you've got a deeper understanding of these specific CCI strategies, how might you think about incorporating them to your own analysis? And maybe what other indicators could potentially complement CCI? Could looking at different time frames or even different assets altogether reveal more nuances in how these techniques work?
Definitely questions worth pondering. How does it fit your style, your markets? That's the next step.